Welcome to Behind the Ticker, the podcast where we go beyond the symbol and into the strategy. I'm Brad Roth, founder and chief investment officer at Thor Funds, and in each episode, I sit down with ETF managers, CIOs, and industry leaders to break down how these funds are actually built, how they behave in real markets, and how advisors use them in real portfolios. Most people just see a ticker symbol, but we know much more goes on behind the ticker. Hey, Michael, welcome to the show.
Hey, good morning, Brad. Thanks for having me.
So why don't you take a little bit of time, give everybody a little bit about your background. It's very interesting as I was doing a little bit of a digging on you. You know, you started at Goldman Sachs, you moved into private equity, spent some time at UBS, and then, you founded a tech company, which I want to talk about. Can you just kind of walk me through your career path and how you ended up starting the Founders Fund?
Yeah, it's a great question. And I sort of tell people this is the third act of my life. So act one, as you saw, was very traditional Wall Street career. Started off at Goldman Sachs and ended up leaving there to work with a Goldman partner when he started his own private equity fund in conjunction with the Carlyle group. Got interested in getting back on the public side of the business and spent some time at Sanford Bernstein and UBS. And you're correct. About 15 years into my career, I really wanted to go on an entrepreneurial journey and had this great idea for a technology product that would allow smartphones to connect without cell service. So we started a company that did that. We originally thought it would be a consumer product company, and it turned out that we ended up having a lot of defense business. We learned a lot about that business. And then this, as you mentioned, is kind of the third act, which is this ETF. And I was inspired. A former colleague of I that I'd worked with at Sanford Bernstein, we saw the Fort McHenry flag at the Smithsonian in Washington, D.C., and some of the other exhibits at the museum. And we said, wow, the people that built America, they're really different. These are iconoclasts, right? And we said, what if we built a portfolio of public securities of only iconoclasts, and founders are really iconoclasts, and that sort of got us to where we're at to start the Founders 100 ETF, owning the 100 best founder-led companies.
No, it's great. We're going to talk a lot about that today and get deep into the fun. But I always like to ask, what do you like to do for fun when you're not working, when you're not trying to be an entrepreneur? I know you are skiing today, but any other hobbies?
Yeah, so I've got my life pretty simple at this point. So work. I like to run a lot, so I've completed a dozen plus marathons, including a few barefoot. I spend a fair amount of time if I'm on the West Coast surfing early in the morning, and then yes, you're correct on my final hobby is skiing. So really those three things. So it's work, running, surfing, or skiing.
So you touched on Beartooth a little bit, but really the question I wanted to get to is you have lived the founder's life firsthand, right? You've co-invented, this technology, you've raised capital, you've built a team. How much of that experience kind of directly shaped what you're doing now with the Founders ETF?
I think it was absolutely imperative. I think it inspired both the inspiration, which is being part of the founder community and working with other great founders and understanding the mindset of these people that build these founder-led companies is just different. And so I think it was important to do that. And I think it was also important to understand how to construct the business. I think had I just stayed as an employee of a well-run Wall Street organization for 25 years, I don't think I would have built the skill set and understanding of how to create my own organization. There was a lot of, we ultimately shipped some very good products with Beartooth, but over the 12 to 14 years that I worked on it, we certainly made a lot of mistakes that I think prepared us to create good products at the Founder ETF. And if you'll allow me to make one more point, I tell people when I meet them, we're not an investment management company. We manage investments, but we're a product development company. And the idea was we wanted to build the best risk reward product for compounding your wealth. And in doing that, that's the product that we've created. So we think of ourselves as a product development company. It just so happens that product that we've built is a tool to allow you to compound your wealth in what we feel is a very good reward to risk profile.
Yeah. And so As we get into the fund here a little bit, I want to just kind of ask, the core thesis really is this founder factor. So can you walk us through what that actually means? How are you defining founder led, and why do you believe it works as an investable characteristic?
Yeah, so I think there's three pieces in there: is how we're defining a founder, what does that factor look like, and why do we think it works? So how we define a founder is the original creator of the company, the person that started it, right? So if it's a Dell computer, it's Michael Dell. If it's Capital One, it's Rich Fairbank. If it's NVIDIA, it's Jensen. And so it's the original company founders still running it. So we talk about, again, we own Dell because Michael's still running it. We don't own Apple because Steve's no longer running it. When we were originally building the portfolio last year, we had Berkshire Hathaway in, but obviously Warren retired, so we don't own uh, a Berkshire. So that's how we define a founder run: is that the original founder is the executive running the company. So they can't just be the chairman, and they can't have stepped back and just run a division. They've got to be running the company. And then as far as the efficacy of the factor, we looked at 30 years of data. I think my partner built an 11,000 stock database looking at this, and we built a histogram of when founders were coming in and out. And by the way, for other investment professionals, this data does not exist in Bloomberg or FactSet. So we had to hand build it, going through old press clippings and old SEC filings to actually build the histogram of when founders came in and out. And if you look at that data, the founder-led companies over a very long period of time tend to outperform the S&P by about 3 to 5%. There's a Bain study that you can reference that shows that the founder-led companies in the S&P 500 outperformed by 3x over 25 years. So we think there's a lot of efficacy in the factor. So that was one, two. And the third is, why do we think the factor works? Is founders bring something special to their company. They're relentless, they're courageous, they have the moral authority to pivot and take their company in the right direction when they need to change direction. And I think it's a unique set that's hard to be replicated, this combination of both big vision and the ability to execute both large and small details.
Yeah, I would agree with both of those things. And I was going to go into the question, like, what specifically is it about founders that kind of drives that outperformance? I saw both studies, right? I saw a quantitative analysis study that says, they return about 4.5% more return. I read your Bain study at 3.1 x over 15 years, but really, it's ingrained, I think, in a founder. Is it, the skin in the game, the long-term thinking, the willingness to take bigger swings? Like, what do you think is that core mechanism that really allows these founder-led companies to find, some of this excess alpha over companies that, have no longer been utilizing their founder as their head and running the company?
I think it's all of the above that you've named. It's they've set the original vision. They know where that vision needs to go. They know how to make the changes. So I'll give two examples. So Meta is one of our top holdings. As you recall, a few years ago, Mark was investing aggressively in the metaverse. Wall Street didn't like it. The stock got hammered. It wasn't working. And, he instantly pivoted and went a new direction and has created a ton of value since then. A couple of weeks ago, I was asked to weigh in on Elon merging SpaceX and XAI. And again, it's that vision to understand the constraints in a system, understanding that in artificial intelligence, you have compute constraints, you have cooling constraints. And as wild as it sounds to put these things in space, you're just solving the constraints, and now you have the execution to do it at a low cost. And I don't think a board hired CEO could do something that bold and, number one, execute it, and two, have the internal support. So I think that I don't think there's any one thing that a founder does. It's kind of like Jensen talks about. He's like, there's nothing I won't do to drive NVIDIA forward. And I believe it. I guarantee if there's a piece of trash on the floor when he walks through the hallway, he's the first one to pick it up. And that's just, you can't replace that mentality.
Yeah, no, I totally agree. So let's get into the founder fund specifically. The ticker is FFF, and I'm gonna put on the hat because I've done probably 100 of these episodes, and I'm a swag guy. So if you give me swag, I'm gonna wear it. I pass out anything with Thor on it. So let's talk about the ticker FFF. You launched it in 2025, actively managed. What are the actual mechanics of this fund do?
Awesome. So you're exactly right. Well, let's talk about how we manage the fund, and then let's talk about why we chose FFF. So the way we manage the fund is very straightforward, and it's an interesting intersection of fundamental and quantitative. Is how we've combined them, I think, is a bit unique. So we start with the 200 largest founder-led publicly traded companies. That's our starting universe with which we analyze. And we actually run a separate index that you can look at under Bloomberg, trades under Founders, FOUNDERS. And that's the 200 largest founder-led companies. Within that, we pick what we believe to be the 100 best by running a factor model. So anyone who's familiar with, again, Bernstein research, my partner and I both came from Bernstein, we run a Bernstein-esque factor model over the top, which we believe picks out the 100 best from the 200 largest. Then we do a modified market weighting of them. So rather than just running a true market weight where we'd end up with a portfolio with 40% NVIDIA, and as much as we love NVIDIA and as much as we love Jensen, our investors are hiring us to run a broad market portfolio. So we do a modified market cap weighting, and we cap the top weightings so that nothing can exceed 7% at rebalance. So it can grow into a quarter, but at each quarterly rebalance, we cap at 7%, and any excess capitalization flows down to some of the smaller companies, which oftentimes are growing very fast. And so it's a good place to put that capital.
Yeah, so I was looking at the prospectus. It says like 80% of it is rules based, up to 20% is discretionary. So that's an interesting split to me. Like, why not go full systematic? Kind of what is the discretionary sleeve actually doing? Is that your weighting mechanism, or can you talk about what, other than your factor, which is rules based, what is that discretionary piece actually doing, and are you utilizing it at all?
Great question. So effectively, it's all rules based. I'll get into why the 80/20 is written that way. So I think this is something that's really important to point out. Because it's rules based, there's no emotion in this portfolio, right? So it's just the computer model picking the stocks each quarter. The reason we wrote it 80/20 primarily was the ability to put in IPOs that meet our fundamental, that are founder led and meet our criteria.
And so you just mentioned something there, quarterly. So you're doing the factor analysis on a quarterly basis. Let's say an IPO, releases, SpaceX does its IPO, right? And you want to get it in the portfolio. Do you wait till next quarterly rebalance, or is that discretionary piece that says, hey, we want to put this SpaceX in here, let's just put it in the portfolio?
That's the discretionary that we could buy on the IPO for companies that meet all the other requirements.
Yeah. So you've got some big mega cap tech names in here, like you mentioned. You got the NVIDIAs in there, but you've also got names further down the list. You've got Robinhood, Carvana, Viking Holdings, Roblox. How important is that long tail of smaller and mid cap founder led companies to the overall thesis and, I guess, performance of the fund?
Yeah, that's a great question. And we looked at a fund size everywhere from 15 names to 200 names, and we really found 100 was sort of the sweet spot. And yes, some of those tail names are actually growing very fast. And so when we're cycling that excess capital back into them, it's providing performance to the fund. One of the things that we looked at was over that 30-year history of these types of names, where did the performance come from? And about 50% of the performance came from about 500 names, meaning the performance is not just coming from the mega caps and the top holdings. The performance is coming all across the investment portfolio.
So I also took a look at the holdings, like 10%, or their top 10 holdings are about 53% of the portfolio. Is that a concentration feature by design you want? Or is that, I don't view it as a risk, but is that by design? Is that a conviction bet in some way, shape, or form?
I think that's driven by the market cap weightings. That's really what's driving it there. And yes, you're correct. We have about 50% of the portfolio in the top 10 or 12 names, and then the other 50% of the portfolio and the other 90 names.
So the fund is about 2 months or 2 months old, I think. You're in the very early innings. It's very it's a very crowded space. So what's the distribution, not for founder-led ETFs, but the number of ETFs that have been launched over the last couple of years? I call it the ETF Thunderdome. I think that's the term everybody's using now. Um, you have past experience as a founder. What's the distribution strategy? How are you going to try to get in front of advisors? How are you going to try and make some noise in a very loud room?
Yeah, so I think, the first one is I think it was Paul Graham says things that don't scale, right? So a lot of it is personal outreach from my partner and I. And then there's the systematic things, using some of the tools in an automated way to get in front of advisors, especially some of the smaller advisors that are looking for exciting new product to talk to their customers about. And what I would highlight is, even though the ETF space is very noisy, I think the statistics are 10 a week launch. Last time I talked to one of the exchanges, as you know, someone else who's built a really high quality, long-term compoundable product, 95% of these things are not long-term compounders, right? They're flavor of the day, double levered this, triple inverse levered that. They're not investable. They're not something that you can put your child, your grandma, your mom into. We've built a vehicle that compounds over very, very long periods of time. We think it's unique, something an advisor can put into their portfolio and is not simply an overlap with the Qs or the SPYs. For example, we have 85% active share with the S&P 500 and 70% active share with the triple Qs. You know from your time in the industry that the old active managers used to brag about 1 to 7% active share, right? We're running 85 to 70%. So we think that we're going to slowly break out of the noise by an easy to understand strategy that resonates, right? If you're an RIA, your end investors got wealthy themselves by being founders. So it resonates with them at a very high level. The data shows that the factors should continue to be efficacious. I think you and I should probably note that past performance is not a guarantee of the future, but if the last 30 years keeps going, it should be very efficacious. And so, to your point, it's a very noisy space, but we think, just like you have, we think we've built something that's very unique and enduring. And so we'll put in the things that don't scale, and then we'll use some of the tools to continue to get in front of investors. And then we do a lot of things. We really appreciate talking with folks like you who want to do outreach with us, who've got you're a trusted source to your viewers on how to understand capital markets. And we'll do outreach like that so that people can start to learn our story and make a decision for themselves.
Yeah, so you brought up advisor discussions. How would you, if you're sitting down with an advisor, he's got a diversified model portfolio suite that he's delivering to clients, like, what is the recommendation here on how they should be viewing FFF? Where does it fit? We've talked, at length about why it makes sense, but if you're looking at a diversified portfolio, I'm assuming somewhere in the large and mid cap equity is where you're going to try to pull some weighting from and add it to your product.
Absolutely. One of the things that we like about this product is we believe it's a core equity holding on the growthier side. So we think that we fit in that core growth sleeve. Given it's a broad market portfolio and that our sector weightings are relatively diverse, lining up relatively well with the S&P 500. There's a few places we're slightly overweight, a few places we're slightly underweight. We don't own any utilities, although I suspect we're going to see a cycle of founder-led utilities to power this AI boom. So we believe we can sit down with an advisor and show them this is a one-for-one replacement for some of their core growth holdings. For example, and we didn't talk about FFF, but one of the reasons my partner chose FFF, we thought it was very easy to remember. And we believe over time, this is a one-for-one improvement over the QQQs. When the QQQs were released on March 10th of 1999, they were supposed to be the innovation ETF. It was these technology stocks. What's happened over time is NASDAQ is trying to earn more and more listings. So over time, it's bleeding out innovation, and they're putting in all these very old, slow growth companies that have nothing to do with innovation simply to earn listings. So when we sit down with an advisor and we show them the opportunity to own broad market innovation by all these founder-led companies, we see good uptake from them because they realize the Qs are getting less and less innovative every day, and we're driving pure innovation. So those are some of the conversations that we have, and we think that make it easy for advisors to bring our product in.
Well, Michael, it seems like you have your thumb on the pulse of a lot of these founder-led companies and maybe future IPOs. What do you want to own that you can't own yet that you're hoping you get a chance to get your investors invested in it through FFF?
So we try to be agnostic to names, right? Since we've built a model portfolio, we like the model just to pick them. I'm going to answer your question, by the way. I'm going to get there. But
I would have given the same answer as a systematic manager. I would have said the same thing as the clause, but you got to have it a little bit of opinion on something you want in.
Yeah. So I'll close it out and then I'll give you the answer. We love my favorite comment is the Jim Simmons comment. He says at Renaissance, you could do anything you want except for override the computer. So we're a big believer in the system. That being said, of course, I'm excited to own when we're going to be able to own some SpaceX. I think that, Elon, without restating the obvious, is a generational entrepreneur and ability to create new things and see around corners and execute around those corners. The Collison brothers, I was an early user of Stripe at my old company. We were so early, I used to get to talk to them. Okay. That's how long I've been using Stripe. I'd be excited to buy some Stripe. I think they really have done some great things. And there's probably some really interesting companies that we don't even know about yet. I think Palmer's doing a nice job about really refocusing people on let's actually help our warfighters with tools that help them rather than just bleed the American taxpayer through kind of endless cost plus programs. So I think those probably won't surprise anyone. What I want to own are the ones that I don't even know about yet. Those I think will be interesting.
That's great. So I was curious to ask you because I've been an entrepreneur and a founder for 15 years. You had a 15-year stint as a technology, running a technology company and doing cool things. What is it about, the ETF industry and launching your own product here and trying to grow this business that are similar to maybe some of your prior entrepreneurship journeys? Like, it's kind of the same playbook, but a different game. But I think you need all the same characteristics. So, what have you brought from your past into this business that might be a little bit unique? And how is running an ETF company similar or very different than maybe running a more of a technology driven company that you were doing in the past?
Yeah, so I think I'm still learning a lot about running an ETF. As I tell people really early on, I said, look, before January 6th of last year, I really knew nothing about an ETF other than owning some. And we really dug in and had to learn about how to execute it and build it and work with the right partners. So I think we're still learning every day. But, there's some similarities that, I think really designing the product with the customer in mind, right? So it's not about creating a solution and finding a problem. It's understanding a problem and bringing that to the customer. My viewpoint is I like to have 30-year vision goals, but execute in 30 seconds, right? Yeah. So I typically tell people I'm thinking about where I want to go 30 years from now, but but this week is what I want done this week. And so I think that's where those things overlap. We have a small team at the ETF, but we kind of run our build the same way we used to do engineering cycles at Beartooth. Is we'll do a weekly sprint every week. And one of the disciplines is you can even decide, hopefully something's done at the end of the sprint, but it's the discipline. If something new has become more important, it's just to not even finish what you're doing and move on. And that's a hard skill to teach yourself. and others, but that's a discipline that we've built. And then I guess just on the customer acquisition side, I think about, we had our consumer side where we would acquire customers for Beartooth, and then also our long, obviously selling to the government could be very long cycle. And so I think there's some analog in ETF world where in retail or small RIAs can be very fast moving and creating some contact and interest with them. And on the institutional side, or the wirehouse side could be very long lead cycle. So I think those are the parallels, but really being direct, it's like we're learning every day about ETFs, but some of the tools are amazing. For example, speaking of AI, a year ago they weren't good enough to do your securities filings and legal work. As of about last summer, in my opinion, they're now better than any fancy New York law firm you could hire at their ability to write a document, analyze a document. Obviously, we still consult with our 40 Act lawyers to make sure everything is correct. But, the ability to learn if you want now, I think has never been better. So that's a long-winded way of saying we're still learning a ton about ETFs, but we're really naturally curious people, and the tools exist to enable you on that learning journey.
Yeah, I have a similar sentiment and feeling with AI. I think even in the last 3 weeks, it's made a major jump to allow us to do some other things. But I find it interesting. You and I are very similar. It's that longer term vision. Where do we want to go? Um, I might not say every 30 seconds, but that every week being able to figure out what you want to get accomplished, run after it. But I find it very interesting, and I want to expand on it just a hair, is that ability to pivot, right? Especially when you're building a new business. There's things that you learn. My partners and I always say, none of us have a monopoly of the best ideas. And so when new things come, you have to have that ability to pivot. And I think that goes back to one of the reasons why the companies inside FFF can be successful and provide some excess alpha. So is how do you kind of look at making some of those decisions when they happen in real time? For example, maybe you're working on a marketing plan, but something new comes up. Like how do you iterate? Or are you just kind of like, hey, I love this, let's go? Are you sitting down with your team and saying, hey, let's think this through? How does everything work together? We want to make sure that this is right when we go. Or are you running, hey, if we break it, we'll fix it along the way?
Yeah, I try to borrow a little bit from Jeff Bezos on the one-way door and two-way door. If something is quickly reversible, i.e. just spending a little bit of money, we obviously want to be effective with our capital and have high returns on the ways we invest. But if it's a one-way door, we spend some money, it works, it doesn't work. Like we try to move quickly on those types of things. And if it's a two-way door, we might want to be a little bit more deliberate. So an example would be a one-way door. We might hire, a prospecting database or an outreach company. That's a one-way door. We spend the money, it works, it doesn't work. If we're going to partner with a wholesaler, that could be a 3-year, 5-year, 10-year lifetime commitment. That's something we're going to really dig in and make sure it's the right partnership. So I think it's just adjusting between those two risk parameters.
So, Michael, I appreciate you hanging out with me today. As you can tell, I do I like the story of the founders. I love the story of the fund. I wish you a ton of success. Before I let you go, where can people learn more information about the Founders Fund and get everything they need to know about FFF?
Yeah, so the best place to learn about FFF is at Founder ETFs, founderetfs.com. Michael at founderetfs.com will go directly to me. I love talking to people if you want to reach out and learn more about the fund. And in the website there, we have, a lot of materials we've written, whether it's be content on the website, a one-pager, or links to our SEC filings and prospectus. And the fund can be bought at any of your favorite brokers. So Charles Schwab, Fidelity, Vanguard, Interactive Brokers, public.com, all easy places to go buy the fund.
Okay. Well, thanks for hanging out with me today.
Fantastic. We really appreciate being on and think that hat looks great on you.
All right, man. We'll talk to you soon. Bye.
See ya.